Hi, my name is Dean Mead, and I'm a partner and government and public sector subline leader with Carr, and Ingram, or CRI. In this brief video, we'll talk about the deferrals related to defined benefit pensions and other post-employment benefits, or OPEB, such as health insurance, that governments provide to their employees when they retire. These deferrals are among the most common that governments report, and perhaps the toughest to understand. To understand the deferrals related to pensions and OPEB, we need to first talk about how governments measure their pension and OPEB liabilities and expenses. Employees in defined benefit plans earn their retirement benefits as they work for the government from the time they are hired to the year they retire. They then collect the benefits after retirement as long as they live, and in some cases, their beneficiaries may continue to receive benefits after that. The amount of benefit payments is based on a formula that typically includes, among other pieces, one's salary at the time of retirement. Governments seek to contribute each year to the plan an amount that, when invested long term, will produce enough assets to make those future benefit payments. To measure a government's liability for those future benefit payments, a plan hires an actuary to perform complex calculations based on assumptions about relevant future economic and demographic factors, such as inflation, life expectancy, and salary growth. Those calculations project the amount of annual benefit payments that will be made to each retiree after they retire. The actuary next discounts those future benefit payment projections to what their value would be today, called the actuarial present value, or APV. The APV is allocated in part to past years of employment, what has been earned so far by the employee, and in part to future years of employment, what the employee will earn going forward. The portion related to past years of service is the total pension liability, or total OPEB liability, the gross amount that the government owes to its current and retired employees in the plan. The value of the plan's investments and other assets on the date that the total liability is measured is called the plan's fiduciary net position. If you subtract that from the total liability, you get the net pension liability, or net OPEB liability, that a government is required to report in its government-wide statement of net position. A government's annual pension or OPEB expense essentially derives from the change in the net liability each year. The net liability changes due to factors that increase or decrease the total liability and the fiduciary net position. The biggest factors that increase the total liability each year are the normal cost, which is the cost of benefits newly earned by employees in the past year, and interest on the beginning balance of the total liability. As we just learned, the measurement of the liability incorporates a variety of assumptions about economic and demographic factors that determine the amount of benefits to be paid in the future. Changes in those assumptions affect the size of the liability. For example, if a government changes its assumptions about life expectancy to reflect the fact that retirees are living longer, the result will be an increase in the projected future benefit payments, and therefore an increase in the liability. In any given year, the actual economic and demographic indicators likely will be higher or lower than the long-run assumptions used to calculate the liability. When the differences between the actual and projected indicators cause the liability to increase, for instance, if the inflation assumption is 2%, but actual inflation was 3% last year, they are called experience losses. Benefit payments to retirees reduce the amount owed to them, the total liability. Assumption changes also can reduce the total liability. For example, a lower assumption about annual salary increases would reduce projected benefit payments and thereby reduce the liability. The differences between actual and projected indicators that cause the liability to decrease, for instance, if the inflation assumption is 3%, but the actual inflation was 2% last year, are called experience gains. Lastly, another thing that may add to or reduce the total liability is a change in benefit terms. For example, if the number of years that employees were required to work to receive full pension benefits was increased from 25 to 30, it would push off the future benefit payments and, all other factors being equal, reduce the liability. On the other hand, if employees were given a boost in the percentage of final pay that determines their benefit payments, it would increase the liability. Again, all other factors being equal. Contributions to the plan from the government, other governments, and the employees add to the plan's fiduciary net position, as do earnings on the plan's investments. Changes in assumptions and experience gains also may increase fiduciary net position. Benefit payments not only reduce the amount owed, they reduce the amount of assets in the plan. If the plan has investment losses instead of gains, that too will reduce fiduciary net position. Lastly, changes in assumptions and experience losses may reduce the plan's assets. Those increases and decreases in the liability determine the annual amount of pension and OPEB expenses that will be reported by governments. And they don't all contribute to expenses the same way. The accounting standards for pensions and OPEB are based on the idea that those benefits are earned by employees in a transaction with their employer governments that extends throughout an employee's career with the government, rather than as separate transactions between employee and government each year. Consequently, although the typically largest increases in the pension and OPEB liabilities are reported as expenses right away, some of the other increases and decreases in the liabilities are initially reported as deferred outflows and deferred inflows respectively, and reported as expense in increments over multiple years. 4 types of increases and decreases in the liability are reported first as deferrals and then included in pension and OPEB expenses incrementally over a period equal to the average remaining years of service of both active employees and retirees. Those are deferrals intended to get the expenses in the right years, instead of all at once, gradually over several years as the employees continue to work for their governments and earn benefits. We've discussed 2 already: changes in assumptions and differences between expected and actual economic and demographic factors. That is, experience gains and losses. The other 2 are related to governments participating in what are called cost-sharing multiple employer plans. In a cost-sharing multiple employer pension or OPEB plan, 2 or more governments, and often dozens or hundreds of governments, pool their contributions and those of the employees and invest them together long-term. All benefit payments to the participating government's retirees are made from that common pool of assets, as well as administrative costs, hence the name cost-sharing. These types of pension and OPEB plans are beneficial, especially for smaller governments, because investing together generally earns more income than if they invested separately, and administering the plan is less expensive than if each government administered its own plan. In order to determine the amounts that each participating government should report in its financial statements for pension and OPEB liabilities, expenses, and deferrals, the plan calculates each government's percentage of all participating governments, typically by dividing the government's contributions to the plan by all government's contributions to the plan. That percentage is called the government's proportion. The total liability, expense, and deferrals for the whole plan are multiplied by a government's proportion to calculate its proportionate shares, the amounts it will report in its own financial statements. Over time, a government's proportion is likely to rise or fall. An increase in its proportion would increase its proportionate share of the pension or OPEB liability, which would add to the expense. A decrease in its proportion would decrease its proportionate share of the liability and reduce the expense. Also, because the proportions that the plan calculates are based on prior year's contributions, a government's actual proportionate share of the liability may turn out to be greater or smaller than what was calculated. Respectively, that adds to or reduces the expense. Like changes in assumptions and experience gains and losses, the effects on the liabilities of changes in proportion and differences between expected and actual proportionate shares are initially reported as deferrals and brought into expense over the average remaining years that the employees and retirees will work. The final factor that affects pension and OPEB expenses gradually relates to the investment earnings on the plan's assets. This deferral is the kind that not only helps get the expenses in the correct years, but also in the correct amounts. The actuary's measurement of the liability not only includes assumptions about demographic and economic factors, it also incorporates an assumption about how much the plan's investments will earn when invested long-term. That assumption is an average annual return, such as 6 or 7%. Similar to experience gains and losses and the difference between expected and actual proportionate shares, The actual investment earnings in any given year are likely to be above or below the assumed annual average. If actual earnings for the year are above the assumed annual average, it increases the plan's fiduciary net position more than expected, which in turn reduces the net pension or OPEB liability. On the other hand, if actual earnings for the year are below the assumed annual average, the plan's fiduciary net position is lower than expected, which in turn increases the net pension or OPEB liability. The effects of those differences between projected and actual investment earnings are initially reported as deferrals and then brought into pension and OPEB expenses gradually over a 5-year period, usually in equal amounts. This is an actual note to financial statements from a government's annual audit. It shows the balances of deferrals related to pensions or OPEB as of the end of the fiscal year by cause of the deferral. All of the deferrals we've discussed are included in this example, with the two related to cost-sharing multiple employer plans sometimes being combined into a single row, as was done here. You likely will see separate deferred inflows and deferred outflows for each of the deferrals, except for the difference between projected and actual investment earnings. That deferral is always reported as a net deferred inflow or a net deferred outflow. The government in this example had a net deferred outflow. That note disclosure also shows when the total deferred inflows and deferred outflows will be included in pension or OPEB expense. The first portion of the deferral is included in the current year's expense, and the remainder is included in subsequent years. For all but the difference between projected and actual earnings, that period is the average remaining service years of the employees and retirees combined. CRI provides a range of free resources to help you understand deferrals. In addition to a recording of a detailed presentation, Demystifying Deferrals, there are other short takes videos answering key questions about deferrals, as well as slide decks for all of the recordings, a companion slide deck that dives into the technical requirements of all of the deferrals required by the GASB, including debits and credits, a short plain language article that covers deferrals in a nutshell, a longer plain language article that covers the same ground as the detailed presentation, a third plain language article that explores how municipal bond analysts, taxpayer associations, legislative staff, and other users of financial statements can utilize deferrals information to evaluate a government's financial health, make decisions, and assess government accountability. And best of all, an ebook that encompasses all of those resources and can be found on CRI's website at criadv.com.